Welcome back to the channel. My name is Patrick, and in today's video we have a trade recap. It should have been a live trade, but I was on the school run this morning, so I wasn't able to get on the laptop to be able to record this video. So it's just the trade is just finished now. I mean, it took about 3 hours as well, so it wasn't ideal. So I'm going to recap this trade for you, and also I'm going to address a comment I had, or well, a question I had in the comment section. Okay, so let's start with that. So what about unicorn model plus silver bullet double concept strategy on GU Nasdaq using a negative risk to reward ratio? I'm assuming risking 1 trying to get 0.5. Can that be a 85% plus win rate? And what do you think of this? And also 2 pairs, 1 minute entry, 40 deals per month, 34 wins, 6 stops, and 9 are easy. Okay, that's the comment, right? So I'm gonna try to answer it the best I can. Basically, what I understand from this, is it possible to, using this price action, the unicorn model and silver bullet, which is new concepts to me, new strategies to me, but it is just price action, so I like that. On GU, on Nasdaq, 2 very volatile assets, but they are quite liquid, so you can actually get these quantities of trades after using those pairs. There's always some action on those pairs, so you are able to get a few deals within a month, so that's possible. 40 deals meaning you're taking 1 trade a day on each pair, and through the month you get your 40 deals. Okay, I understand that. And using a negative risk to reward ratio, can all that put together lead you to getting a win rate of 85%? Short answer, yes, it can. Is it likely? Not likely, because it's not guaranteed. Okay, and the reason I say it's not likely is because there's so much things you need to take into account, and there's so many things that's out of your control, and most of that is down to manipulation and market structure. Okay, so you can achieve these things, but the only way you even come close to achieving this is to be disciplined. Okay, is to follow the set price actions that you've highlighted that works. You back tested it, you know the win rate, you like it, you know how to spot it on your pairs that you trade, and consistently, repeatedly doing the same things that work. Okay, whether you get a 85% win rate or not, that's not important. You don't need that to be profitable. Using a negative 1 to 0.5 risk, you probably need about 70% or 75%, and you'll be profitable. Okay, so you don't need an 85% win rate to be able to achieve that. The key is to be able to manage your risk. Okay, so that's something to consider. If you are trying to achieve that, hopefully you can, but it is important to manage your risk. What I really like about your comments, or what you're suggesting, is the fact that you focus on price action, and you also focus on using 2 pairs, the same pairs. So that's going to lead you towards a more structured way of trading. Okay, and that's what I found that works for me, and I'm going to share with you this trade in a second, but this is all based on price action. Me paying attention to the same pair. You guys know I've been trading Euro USD for a long time now. I'll be focus on the price action, so no indicators distracting me, and because of that I was able to see something that happens occasionally, and every time it happens, the results, I'll show you the results in a second. So price action, same routine, people. Okay, but this is slightly different, so I found this interesting, and this is why I wanted to share this trade with you. Okay, so we are trending up. Hatron, you can see I mentioned in videos previously, trending up here. Here's a pullback, reversal here. I don't like that reversal, by the way, but it did lead to a break in structure, and it's trending up. So potentially here's a low, higher low, That's a higher low, and it's going to continue creating higher lows, right? It did break this higher low, so you thought it's reversing, which it did. Came down here, but now it's hit this point here where it started this bullish run, and it's putting a reversal and it's going back up. So maybe it continues its uptrend. So I saw that this morning and I thought, okay, where's price sitting? And price was sitting up here. So am I going to buy it here to take it up? No, I'm expecting it to pull back before it goes up. So I'm looking for that pullback to be my trade, you know, scout that, and that's me done for the day. So that's what I was looking for, that little pullback. So to get that, I needed price action to confirm what I was doing was right, and also I needed to make sure I was in the right place to be selling. Okay, and as you can see, we are at highs, so selling from here makes sense to me. So if I use a negative risk reward ratio, my stop loss is going to be up here where it's supposed to be, nice and safe, swing highs, right? And selling down makes sense because, you know, the structure of the market. So that was straightforward. Okay, what I found really interesting about this was this. Okay, so I got in, say, so I saw it here and I got in roughly around here. Okay, so what then happened is it pulled down. Wait, TP for me was, let's see, they say, I can't remember. I don't want to show you the entry yet. I'll show you at the end the entry. So breaker structure would have been there. Yeah, that was it. Okay, cool. So I got in roughly around here. Okay, so we had the trend here, and as you can see, it came down here, flagged up like it's continuing, and it came down, and for it to continue its trend from here, it should drive up. Okay, but it didn't. It pulled back and broke this last low. So we had higher lows all the way through, and it broke that higher low there. So that was my breaking structure, and because of that I got in roughly around here. Okay, so I then expected it to drive down to give me my scalp. So I use a negative risk reward ratio because these highs are more or less equal, right? I do not trust equal highs. Okay, so having my stop loss just above here, you know, it was too tight, so I needed more breathing room. So I used my negative risk reward ratio, risking 20, looking for 10 in theory. Okay, or risking 1, looking for 0.5. okay, that's what I actually did here, right? So risking 2, looking for 1, risking 1, looking for 0.5, the same thing, right? So I had my stop loss a little bit further up. Okay, let's just leave that for now, it doesn't matter now, you know how I do it. So what was important about this was me staying in this move, because as you can see, when price came here, it pushed all the way back up and it almost stopped us up if I had my stop loss there. When it breaks this high here, this is when I'll be panicking that I'm not getting the move, but it didn't. It stopped there and pushed back down. But when I saw this was now clearly equal highs. So I believe now that it is setting up to come up here later and run those equal highs, which it tends to do. Okay, not all the time, it tends to do it. Okay, so we've got equal highs. We know now there's liquidity above here. So I saw that when it came up here, pull back down, I thought, oh, do you know what, I might need to get out here, because typically it should pull back here, push up and run those equal highs, and if it doesn't do it here, eventually it's going to do it. But I stayed in the move. Why? Okay, I don't like this setup no more. Initially I did. I don't like it no more. I wanted to get out, but I stayed in the move, and I got into the move maybe, actually let me just show you my entries. I got into move like maybe an hour before London session started. Okay, I got into move here, right, an hour before London session started, and it took us, what was that, 3 hours? 3 hours to TP. My TP tends to be like 30 minutes. When we had a breaking structure here, it drives to run liquidity. This is market manipulation. It wanted to create this bank of stop losses that's going to be above here before it comes up and takes it. I knew that. I've seen that so many times. I know that, should I say. I know that. And I've seen it so many times. So I still believe this is going to drive up. But I stayed in the move, even though I had the opportunity to get out here, break even trade or even a small profit. Because once I saw these equal highs, I didn't want to be in this move. That confirmed to me that price is going to come up eventually to run the stop losses above there. So I don't want to be here anymore. So when it came down here, I really wanted to get out, but I stayed in the move. And the only reason I stayed in the move was one little glitch, one little mistake they made in the market. And this is why I preach trading without indicators, because an indicator would not have shown you this. And trading the same pairs, trading the same pair or the same instrument, you get used to seeing certain things, and you spot the little issues or the little faults or mistakes the market makes in price action. Okay, so price action is king. What did I spot? Let me just mark it up. I'm just going to draw it out for you so you can see. I spotted this, and this is what this video really is about. Okay, spotting gaps in the market. Right there, right there. That's our little gap in the market. Okay, I don't know if you can see it yet. I'm going to zoom in a little bit more. That's our gap in the market that I spotted. Let me just get rid of that. Okay, right here. Let's zoom in all the way in, and you can see it clearly. So on the 5-minute time frame here, what we have is an actual gap in price action. Yeah, right here where prices bouncing between. As you can see, normally each candle trades within the other candle, especially on the 5-minute chart and on the 1-minute chart and almost every single chart time frame. So this pushes out, it trades within this candle, pushes out, pulls back into this. We know this is how price moves now. Okay, if you've been following the channel, we know it breaks out, it pulls back in, it breaks out, it pulls back in. Here, from this high here, it broke out, but there was no pullback in, and there was this little gap. It's such a small gap. So if we had the wick that just tagged into here, that would be fine. But because this candle did not trade within this candle, I spotted that gap, and I knew for certain, almost for certain, that I had a strong possibility that probability that price was gonna come back, which it did. Okay, so that is why I held my trade. So it was the right move because I'm selling from highs. But when the price action started producing triple highs and all this, and I expected that it's safe to assume price is coming back here to run the stop losses here. That's liquidity, right? Eventually it will run it. When, we don't know. So that's why I'm not trying to buy this to take it up, by the way. So that little gap there made me stay in the move, and this is what I wanted to talk about: gaps in the market. Okay, there's another gap there. There's a little gap here. Price pull back into it. Gaps in the market. When you see it, you can actually use it to target a trade. So if you enter a trade and you spot a gap, you can actually use it to target that zone. Okay, because gaps in the market, the price tends to come back to those gaps to fill it. Okay, I'm going to show you a few examples. So that's the example in the trade I took this morning. As you can see, it was a winning trade. I held it all the way through, won the trade, yada yada yada. Okay, what I want to show you is more examples of this, because I spotted a few times. I thought, okay, this is quite interesting. There's a few gaps in the market here. Price tends to come back here. I want to learn how to trade. Actually, there was one on Euro USD. Let's go back to Euro USD. There's a massive one. And this is when I spotted it, paid attention to what was going on. And when I saw this opportunity again, I took the trade based on that. Okay, so let's see, where was it? It was visible on the 5-minute chart. It was here. It was there, and that's the 23rd. Okay, so let's go quickly 23rd, and you can see what I am talking about. The 23rd. Yeah, look, there's another gap in the market. Eventually price will get down there. It's not there yet. This is the problem with this though, okay? I don't go looking for gaps in the market and just enter here hoping it's going to get down there. I don't do that, okay? I was just taking my routine trade as I do. Notice there was a gap and I expected price to come back here. Here, there was no entry to take this down. So, you know, plain and simple. If there was an entry here, somewhere here, I would take it down to that gap in the market. And why would I do this? Basically, these gaps in the market is usually an imbalance. This is a clear imbalance. And imbalances tend to leave pending orders, which the market tries to fill. Eventually, it will fill this imbalance, okay? So mark my words, this is 9th of May. Eventually, price will come back down here to fill this imbalance. The problem is, I don't know when. So I don't trade based on that information, okay? I'm not telling you to trade on it. I'm just saying this is what happens when there's gaps in the market. Price eventually does come back to fill it, okay? Okay, so I finally found the gap I was talking about, and there's actually two. I spotted it and I thought, okay, this is quite interesting. And it also happens like on the weekend. So Friday, end of the trading day, then you got Saturday, Sunday, then Monday, sometimes the market will just gap up, right? So if you understand what I'm talking about, so imagine price finished here on a Friday, Monday morning, sometimes price action will start from here, leaving that massive gap. So eventually what price does is reverse and comes down to fill that gap. Okay, so I spotted that a few times. Then when I spotted it on this price action here, I thought, okay, cool. This is something interesting, something I should be paying attention to. So here's the first gap. So price shot down aggressively here, right? And left that massive gap there. So it came back here, pulled back up. I expected that. So I thought, okay, cool, it's cleared this gap, but it's left this gap as well, right? So got up here, shot down, I came all the way down to fill that gap. And in doing so, it left this gap. And look what it did. Eventually it came all the way back the next day to fill that gap as well, okay? So when I spotted that, I thought, okay, I need to pay attention to these gaps. When they're left there, price tends to come back and reverse into it, dig back into it, dig back into it. So when I spot it, I need to be paying attention to it, okay? So same thing applies when it's on like a weekend. So you have a weekend here. I think it's on NASDAQ. Let's switch over to NASDAQ quickly. Let's see if we could find an example of it there on the weekend. It tends to gap up a fair bit with NASDAQ over the weekend. Let's see if we could find any examples. There you go. There's one there. It happens more on NASDAQ. So that might be a price action you want to be paying attention to, okay? So there's a little gap there, but as you can see, it filled it already. It's almost every weekend it does this. So Monday mornings, there you go, another gap there. So from here, it left a gap and just pushed up. Okay, so if you're trading London's Asia session, maybe you want to enter and try and get there. It didn't happen. London session, or what's this? New York session. That's when it came back to fill that gap. Okay, so I wouldn't just, what I'm saying to you is I would not just get into an entry, a sell for here, a hope it goes back there, because it could drive up significantly before it comes down. What I would do is what I tend to do, look for price action here, probably on the 1 minute chart. You can see this, we had the trend, then we had a breaking structure here, and it started driving down. When it started driving down here, if you entered roughly here, so we had a pole, flag, enter in here, taking that trade, you could hold that and fill that gap, and that would have gave you a 100 pip move, yeah, and stop loss probably about there or so, or just actually above this flag with NAS 100, just above this flag there, and you're risking about 27 points to make 116 points. Okay, and as you can see, it went down a lot further. Yeah, so it's just something I wanted to highlight. If you are trading using naked charts, pay attention to the pair. If you see gaps in the market, pay attention to it. If you see your entry, well, my entry is based on price action, so we have a trend and a breaking structure, and I've entered based on that. I can now hold this move from the breaker structure all the way down to the gap in the market, because it's very likely price is going to fill it. Okay, not all the time, but it's very likely. So if I'm scalping this, maybe I take my initial scalp and leave a runner. Okay, that's how I'll play it. So it's just something new I wanted to share with you guys. You know how I like to do when I learn something new, I like to share it. That's how it reinforces my knowledge, by the way, by sharing information. If you found it useful, you know what to do. Hit the like button. If you do have any more questions, let me know. I'll try to address them as soon as I can. This is Patrick signing out. Until next time, peace.